Ever seen a tiny snowball rolling down a hill? What happens? It gathers more snow, right? And before you know it, it's turned into this massive, unstoppable force of nature. Big names in investing, like Warren Buffett, use something called Dividend Snowball. But instead of snow, this ball is made up of dividend payments from different stocks in your investment portfolio. As it rolls down the hill of time, it gathers more dividends, compounding its growth exponentially. So how does this whole thing work? And more importantly, how can it help you earn $5,000 in monthly income? In this video, I'll show you two strategies, a one-time investment and a monthly investment of $200 to reach a $5,000 per month goal. In the end, I'll show you a portfolio of stocks that has the potential to triple that return over the long run. So what exactly is the dividend snowball effect? Well, it's simpler than you might think. When a company pays out dividends, you use that money to buy more shares of the stock. These additional shares mean you'll get even bigger dividend payments next time around. This compounding effect causes your investment to grow exponentially over time, much like a snowball growing as it rolls downhill. In other words, the growth isn't linear, it's exponential, meaning it accelerates over time. The key is patience and reinvestment. Set up your investments with dividend-paying companies, then sit back and let your dividends grow and compound your portfolio over time. Just like a snowball gains size and momentum, your investments will grow too. But truthfully, understanding the concept is one thing, actually putting it into practice is another. So let's get into some real strategies that you can use to set your dividend snowball rolling. The first step starts with setting a goal of monthly dividends. And everyone's investment journey is unique. Some people want to make $1,000 a month, while others may want to earn $5,000 per month. When planning how to invest or diversify your portfolio, it's important to consider your individual financial situation and what makes the most sense for you. For this video, John will explore two strategies to determine if they can help him make $5,000 or more a month after retirement. Setting a goal gives you a target to work towards. It also allows you to measure your progress and adjust your strategies as needed. The key here is to be realistic about your timeline and the amount you can invest. Now that we have a goal, we need to determine what kind of return in stocks we should be looking for to reach that goal. Which brings us to the next chapter, my two strategies to reach the $5,000 goal. To reach the goal of $5,000 per month after retirement, you need to strategically select stocks that offer a combination of high dividend yield, consistent dividend growth, and solid share price appreciation. These three elements work together to maximize the compounding effect of your investments. Let's get to know the two strategies that can help you achieve this. Strategy 1, John makes a one-time investment of $10,000. Obviously, this strategy demands that one-time investment of $10,000. John has to put it into a stock that meets the following criteria: a current dividend yield of 8%, a dividend growth rate of 7%, and an annual share price appreciation of 6%. Over time, these factors will work together to grow John's investment and his dividend income. Here's how it plays out. After 1 year, his $10,000 investment would grow to $11,400. After 10 years, it would be worth $38,292. After 20 years, it would grow to $158,245. By the end of 30 years, John's initial $10,000 would have reached $710,970. The dividends alone after 30 years would amount to $65,055 annually, which breaks down to about $5,421 per month, meeting our goal. Now let's consider a different approach. Instead of a one-time investment, John decides to invest $200 every month into a similar high-yield, high-growth stock. This strategy leverages the power of regular contributions and compounding dividends over time. With this method, John's consistent monthly investments would look like this. After 1 year, John's invested $2,400. After 10 years, John's investment grows to $47,548. After 20 years, it reaches $246,150. By the end of 30 years, John's total investment would be worth $1,158,011. The annual dividends after 30 years would be $105,740, which translates to about $8,812 per month. Impressive, right? Now remember, at the end, I'll show you how to earn double or triple that amount in dividends with a portfolio of stocks. So we can clearly see that the second strategy has a better output than the first. The reason is that this strategy benefits from the steady, consistent growth of your investments and takes advantage of market fluctuations by spreading your investments over time. It's a great option for those who might not have a large sum to invest initially but can commit to regular contributions. However, there's one big problem here. Finding a single stock that consistently pays over 8% in dividends each year can be challenging. In fact, I don't even recommend stocks that pay dividends above 7%. That's because of the dividend trap. Many new stocks tend to attract investors with significantly high starting dividend yields, and these kinds of companies, in the end, tend to fail, and investors end up losing money rather than gaining it. To address this, I have a solution. Like I said in the beginning, to reach a goal of $5,000, you need a good mix of dividend yield, dividend growth, and share price appreciation. Here's how you do it. In the coming chapter, I'll show you how to create a diversified portfolio that balances high-yield stocks with growth potential, ensuring stability and maximizing returns. So let's talk about making a portfolio. To achieve the goal of earning $5,000 a month in dividend income, it's crucial to create a diversified portfolio that includes different types of high-yield investments. This ensures stability, growth, and consistent income. Let's make an ideal portfolio by focusing on 3 tiers of investments: dividend aristocrats or kings, strong and stable dividend ETFs, and dividend-paying REITs. In the end, I'll show you whether this powerhouse of a portfolio can earn you more than $5,000 in dividends per month or not. Back to making the portfolio. First, let's start with dividend aristocrats or dividend kings. These are companies that have a long history of consistently increasing their dividends. They've been raising the money they pay to investors for at least 25 or 50 years. Based on my research, here are some of the best dividend aristocrats or kings. The first one is Cintas Corporation. It has a current dividend yield of 0.78%, but what really stands out is its impressive dividend growth rate of 21.5% and a 10-year average share price appreciation of 27.07%. Other strong candidates are Abbott Laboratories and Bank of America. Here are the key metrics for each stock. So when we average out the metrics for these stocks, we get a current dividend yield of 1.78%, a dividend growth rate of 23.44%, and a 10-year average share price appreciation of 15.67%. These metrics provide a strong foundation of growth and income stability for your portfolio. Next, let's add strong and stable dividend ETFs to our portfolio. These funds allow you to invest in a basket of high-yielding stocks, offering diversification and ease of management. Some of the solid options in dividend ETFs include the Vanguard Information Technology Index Fund ETF shares, Schwab U.S. Dividend Equity ETF, and the Vanguard Mid-Cap Index Fund ETF shares. By averaging the metrics for these high dividend ETFs, we get a current dividend yield of 1.87%, a dividend growth rate of 12.58%, and a 10-year average share price appreciation of 11.54%. Finally, let's include dividend-paying REITs. Real estate investment trusts are required to distribute at least 90% of their income as dividends, making them a fantastic source of high dividend yields. American Tower Corporation is a prime example, offering a current dividend yield of 3.34%, a dividend growth rate of 18.83%, and a 10-year average share price appreciation of 8.16%. And then there's also CubeSmart and Rexford Industrial Realty. Averaging the metrics for these dividend-paying REITs gives us a current dividend yield of 3.91%, a dividend growth rate of 16.99%, and a 10-year average share price appreciation of 9.81%. These REITs add a significant high-yield component to our portfolio, enhancing both income and growth potential. Now, if you're wondering where I get all that data, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock ratings have been a game-changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So definitely check them out in the description, seeing as they've also promised to give a 20% discount on premium membership with a 7-day free trial at a 10% discount on alpha picks to those in our community who join using the link from the video description. Okay, back to portfolio returns. Combining the metrics of all the tiers, our portfolio averages out to a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%. This balanced mix of stocks, ETFs, and REITs ensures that our portfolio is well diversified and poised for both income generation and capital appreciation. Now that we've established a diversified portfolio, let's get into the detailed projections to see how our investments can grow over time. I'll show you both the one-time investment strategy and the monthly contribution strategy, then determine which one is the best approach to go for. First, let's start with strategy number 1, the one-time investment strategy. Based on a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%, if John invests $10,000 in this portfolio, after 1 year, the investment would grow to approximately $11,486. After 10 years, his investment would be worth about $42,456. At the 20-year mark, John's investment would grow to roughly $217,450. By the end of 30 years, John's initial $10,000 would have ballooned to an impressive $1,514,523, paying around $139,020 in annual dividends. This translates to a monthly dividend income of approximately $11,585. The total value added to John's investment over 30 years would be $1,504,523, with $867,217 coming from capital appreciation and $637,305 from reinvested dividends. This projection highlights the extraordinary growth potential of a well-diversified portfolio. But can strategy 2 beat these numbers? Let's find out. In this scenario, John invests $200 every month into the same diversified portfolio. After the first year, John's total investment would be $2,400. After 10 years, it would grow to about $50,687. After 20 years, John's monthly contributions would accumulate to approximately $316,483. By the end of 30 years, his total investment of $72,000 would grow to a staggering $2,273,335. At this point, the annual dividend income would be around $208,452, providing a significant monthly income of about $17,371. The total value added to John's investment would be $2,201,335, with $1,261,355 from capital appreciation and $939,980 from reinvested dividends. To fully maximize growth, click the video on the screen to discover undervalued dividend stocks that have the potential to turn a $10,000 investment into over $5 million.